Gold closed at $4,598.20, down minus 0.86%, its largest one-day decline since August 18th, pushing our correction risk score down from 90 to 87. But is this setting up for a great buy opportunity or another big correction? Today, we'll look at the latest changes in risk for gold and silver and why the gold miners still remain our biggest warning indicator. If you're wondering whether to hold your core position or take profits before it's too late, here is what the Gold Bar Bot model is saying right now. Here is the latest gold technical risk chart. Gold and silver are beginning to correct rather than continue vertically higher, which is gradually releasing the short-term pressure accumulated during August's extraordinary rally. Gold's decline today is exactly the sort of normal correction that our short-term correction risk index has been warning about. Gold ended today's session $4,598.20, down minus 0.86%, its largest one-day decline since August 18th. Gold nevertheless remains about 13.6% higher month to date and roughly 13.5% below January's record high. Gold's short-term correction score declined 3 points from 90 to 87, but the high correction score isn't automatically bearish for the long-term position. This is healthy. When the correction actually begins, excess momentum is removed and future risk can decline. The secular support for gold remains. Fiscal concerns, central bank demand, and demand for monetary hedges haven't disappeared because of a one-day decline. Here's the latest silver technical risk chart. Silver shows the largest improvement. Its buy opportunity rises 4 points to 51. Silver is progressing more rapidly toward an attractive entry. Silver settled around $67.99, down approximately 0.94%, and at its lowest settlement since August 19th. Even after today's decline, it remains roughly 18% higher month to date. Silver is therefore also moving in the direction we want. Here is the latest gold miners technical risk chart. GDX remains the outlier. The miners have gained roughly 40% in the past month, substantially outperforming bullion, so GDX remains much closer to an extreme sell configuration than gold or silver. GDX remains the outlier with an extreme risk rating of 93. That is extraordinary operating leverage and speculative momentum. The model says GDX core, hold/no addition/watch closely. Finally, here is the latest combined precious metals risk chart. Today's decline is constructive rather than alarming. Correction and crash risks are falling while buy opportunity improves. This is a materially healthier configuration than we had only a few sessions ago. Silver is now closest to becoming attractive for additional core capital. GDX remains the principal risk warning. Risk for metals is beginning to decline while buy opportunity rises. That's precisely what we wanted to see. The complex is still highly vulnerable to short-term volatility, but the probability of a major crash is not increasing. At combined correction 86, we should still regard a normal short-term correction as quite plausible. The immediate bearish catalyst is inflation. Reuters reports headline PCE inflation at 3.7% year over year. Gold fell about 1.3% in spot trading, silver about 1%, and the dollar strengthened about 0.3%. The market now sees roughly a 40% probability of a September Fed hike, with about a 60% probability of no change. That makes Friday's Jackson Hole address especially important. With PCE behind us, Warsh's interpretation of persistent inflation and the rate outlook becomes the most important immediate macro variable for precious metals. If Warsh emphasizes inflation control and keeps further tightening clearly on the table, real yields and the dollar could rise further, extending the metals correction. If instead he signals patience, today's correction could prove relatively shallow. That concludes our latest video update for the precious metals market. For a deeper dive, check out our other free charts and AI analysis at goldbarbot.com, where we track the latest market risk conditions and assess buy opportunities for gold, silver, and the miners. Backtesting our AI model produced a warning to begin scaling out of metals on January 9th, 2026, with a strong warning to sell all positions by January 23rd, a full week before the historic crash event on January 30th. Could you have benefited from that advice? If so, check out goldbarbot.com. New updates are posted several times per week. From all of us at goldbarbot.com, we wish you good luck and good fortune investing in precious metals.